Hello, I'm Ward Brown. I was really looking forward to palling around with my gorilla friends here and pounding my chest a bit about the great year that we had in the markets and at Argent, where all strategies outperformed their stated benchmarks. And then January hit, and there was a little reminder in the back of my head from an old mentor of mine who said, "You better stay humble or the markets will do it for you." So heading into the new year, investors are rightfully asking what we can expect after 3 phenomenal years in the market. The fact is, inflation is on the front page and everyone's hearing about it. The Fed has also recently made very clear they're going to act to try to slow it down. So what does that mean for markets as we head into the new year? Let's take a look. Back to reality. To put it simply, the goal of monetary policy at the Federal Reserve is to keep inflation in check and to keep as many people working as possible. Recently, myriad economic data has affirmed that inflation is not in check at the present time. Higher prices are everywhere, and you've probably felt it when you're checking out at the grocery store or traveling or maybe buying a new car. Recently, the Fed offered a mea culpa of sorts for stating earlier last year that inflation would only be temporary, or transitory as they termed it. Indeed, they have made it very clear that they are going to act to stem inflation at the March meeting by all indications. There are multiple variables behind the rise of inflation. One simple tenet is that demand for goods and services, particularly from the U.S. consumer, is just too high for the world to supply it. Too much demand chasing too few goods is straight out of economics inflation causes 101. Addressing that imbalance is what the Fed is supposed to do. That is primarily accomplished by putting a damper on buyers' demand by raising interest rates so that it costs more to borrow and spend money. So what does that mean for stocks? While it is unrealistic to expect the returns of the last several years to continue indefinitely, if we look back in history, stocks have performed surprisingly well during periods of higher inflation and rising interest rates. As a case in point, in the last 25 years, there have been 8 times when the Federal Reserve began a series of interest rate hikes. In each instance, the market was higher a year later. A number of different factors support the notion that we could do so again. First, stimulus that has already been released does take some time to work its way through the economy. Picture a python who has swallowed its prey but not fully digested it yet. In addition, many companies have pricing power. They can raise the prices they charge to help offset the impact of inflation on their cost structure. That helps their earnings. Indeed, Q4 earnings season has just kicked off and estimates are for another very good showing. There is, of course, a flip side. Inflationary environments typically cause the stock market to value earnings at a lower valuation. Perhaps it is more reasonable to expect the stock market overall to trade at something like 17 or 18 times forward earnings as opposed to 20 times or so where it has been recently. If so, it may take several quarters for earnings to grow enough to get stock prices moving again. Long story short, at Argent, we are not particularly worried about interest rates going up a little. In fact, we believe that what the Fed is doing is the right thing to do. We hope they take a measured approach. If they do, we think the stock market will respond favorably and give us more positive results by year end. Maybe not good enough that I'll need to pull out the old gorilla suit again, but who knows? Thanks very much for watching.